All of you are doing good. I hope you are enjoying this topic. Please attend every day so that you'll get the full benefit. And in case if you have missed it, watch the video again. Right? In the first lecture, we have seen inflation and capital budgeting. And we have covered about 10 questions taken from reference book, study material, past exam, RTP, MTP, etc. Now today's topic will be capital budgeting and risk analysis. Capital projects involves risk because we are dealing with future. Future is uncertain. Future is unpredictable. Whatever you can estimate can go completely wrong. Therefore, there is risk involved in capital budgeting projects. Why risk is involved? Because you are making projection about future sale, future revenue, future cost, future tax rate. All this can undergo change. For example, the government policy can change. Suddenly the government can ban a product and overnight your business can be disrupted. New competitor can emerge in the market and your business can be completely shattered, disturbed. New substitute product can emerge in the market and again your business can get affected. New technology may come. Customers' taste, habit, preferences can change. Because of this, whatever you project can be wrong, and therefore we need to incorporate risk and uncertainty in the decision making. Okay, so there can be three types of decision making situation. One is decision making under certainty, that is cash flows are certain. Chances are very less that you will come across this kind of situation, but there is a possibility if you receive contractual cash flows, if cash flows are contractual and you are going to receive it. Next is decision making involving risk. Risk means variability in the outcome. Actual outcome can be different from the projected outcome. That is called risk. What you are expecting and what you may realize may be different. So when cash flows are risky, we measure the risk by assigning them probabilities. And the third is decision making under uncertainty. Uncertainty is a more dangerous situation than a risky situation. As far as risk is concerned, we can measure the risk by assigning probability. But in case of uncertain situation, you cannot even assign the probability. Like CA exam, okay, and BCom exam. In BCom exam, there is risk. In CA exam, there is uncertainty. I hope the example makes you have the feeling of risk and uncertainty. Okay, because we don't know what will happen. We can't even assign probabilities that this would be the nature of paper, this would be my result. So CA exams are highly uncertain exam. Even the best of the preparation may not give you the desired outcome because the paper can be completely different. Is it right? So in BCom we can assign probability. There is 80% chance that whatever I have studied will be asked. 20% can be new. In CA, can you assign probability to the paper? Who will assign probability? Yes, Hari, would you like to assign probability to your next result? Anup, would you like to assign probability to your next CA result? Divya, would you like to assign probability to your next CA result? Therefore, that is uncertainty. Risk, what is risk? Risk means variability in terms of actual return compared with the estimated return. Are equity shares risky? Are government bonds risky? Please reply. Option A, yes. Option B, no. Yes, no. Tick the right option. Suppose these are the two options to be ticked. Equity share, yes. Government bond, no. Many students are saying equity share, yes. Government bond, no. Why you are saying it? Because in case of equity share, we have some expected return. Based on our calculation, past analysis, we have some expected return. But actual return can be very different. It can be very low or it can be very high. Is it right? It can be very low or it can be very high. In case of government bond, risk is not there because government says you will get 5.5% interest rate, and after 1 year you find that the government bond gives you exactly 5.5% return. So that is called certainty. That is called certainty. Equity share does not have that certainty element. Equity share does not have certainty element, and therefore equity shares are risky. Same thing happens in a project also. In case of project, capital expenditure is incurred today. Returns will be in future. Future cash flows will be estimated by you today to take the decision, but actual outcome can be different. That is the risk. How do you measure the risk? So in this chapter, we are going to measure risk by using standard deviation and coefficient of variation. Those who have studied portfolio chapter, how many of you have studied portfolio chapter? You will find today's topic very easy, because today our job is only to compute standard deviation, coefficient of variation, variance, etc. Okay, so standard deviation measures how much the data deviates from the mean, how much is the variation from the average. If the variation is too high from the average, it means the risk is more. If the deviation is less from the mean, like for example, this is my mean in the center, there will be variation from the mean. These two are normal distribution. I will call it graph A, graph B. Student will tell me which of these two have higher risk, graph A or graph B. Which one indicate higher risk? Which will indicate higher risk, A or B? Which will indicate higher risk? This diagram has a higher deviation from the mean. It has a more deviation from the mean. This line is mean. Mean is in the center of normal distribution. So therefore B is riskier compared to A. And what is coefficient of variation? Coefficient of variation is required when you are comparing two or more projects. So it is risk per unit of return. When risk and return both are different in two projects, you can't compare return and risk because both are different. Then we go to the next measure of standard measure of risk, that is called coefficient of variation. In short, we will call this CV, this will call SD. It has got a symbol also, sigma, right? Difference between risk and uncertainty. In case of risk, probability distribution of cash flow is known. Probability can be assigned. Probability can be assigned. You can say NPV will be 10 lakh with 0.2 probability, NP will be 30 lakh with 0.5 probability, NPV can be 40 lakh with 0.3 probability. If you can assign probability to cash flows or NPVs, then you are dealing with a risky situation, and then you can do further analysis of that. But in case of uncertainty, probability cannot be assigned. The situation may be so uncertain, so risky, so dangerous, even probabilities cannot be assigned. Okay, then that situation is called uncertainty. Okay, visualize your CA exam. CA exams are risky or CA exams are full of uncertainty? Please reply. CA exams are risky or uncertain? Yes, you are right, uncertain. However, these two terms can be used interchangeably. Many people use, and we will also use, risk and uncertainty as if they are same, but they are not actually same, but only for classroom discussion we can assume that they are same. Is it right? Main reason for considering risk in capital budgeting decisions. Now the next question is why we are discussing risk in the capital budgeting decision. It will help us to take decisions. If I incorporate the risk in the decision making, it will help us to take a more appropriate decision, because I am going to consider risk also in decision making. Second is, it will help us to know the real value of cash flow. Cash flows, if full of risk, needs to be adjusted for the risk element. So when you are comparing project A and B, A is less risky and B is more risky. You cannot use same parameters for comparing them. You have to adjust for the risk. We have to adjust for the risk, and therefore you will be able to arrive at realistic value of cash flow, real value of cash flow, and you can compare them appropriately. If it is less risky, I may use 10% discount rate. If it is more risky, I may use 14% discount rate, and therefore we are able to make them comparable. Third reason why we need to incorporate risk is higher risk will lead to higher risk premium. Higher risk premium, and higher risk premium will lead to higher expected return also. Risk needs to be incorporated so as to take more appropriate decision. Next point, factors affecting risk. Some factors can be internal, some factors can be external. Internal means which are within the organization, which are internal to the company, which are within the organization, which are internal to the company. To some extent, they can be controlled. There are two risks we are going to discuss here. One is called project specific risk, and the next one I will call company specific risk. Project specific risk means they are related to a particular project. They are project specific, related to a particular project, and can affect the cash flow of the project. So what are the risks here? The risk here could be a project may not be completed on time. If the project does not get completed on time, there will be cost escalation. There can be cost escalation. There can be delayed revenue. If you don't start the project on time, if you don't complete the project on time, revenue will be delayed. Second risk is that error of estimation in resources. Highly probable you may not be able to exactly estimate how much resources would be required. When we have done the interior of this classroom, we thought that it will cost 20 lakh rupees, but afterwards we found it is costing us 25 lakh rupees. So that was my error of estimation in resources. 5 lakh rupees more I had to incur, because we tried to make estimate, but it goes wrong. You will also find when you do interior of your home, you start with a budget of 10 lakh and it goes up to 15 lakh, or you start with a budget of 20 lakh, it may go to 25 lakh. That is my estimation of resources error. And then another risk is that estimation of cash flows from the project. Future is risky and uncertain, difficult to estimate how much cash flow that particular project will generate. One example of project specific risk. In the exam, the question, MCQ question can be, identify which of the risk is a project specific risk, and then you have to choose the right option. A nuclear power project of power generation company has a different risk than a hydel project. Nuclear power project has a different set of risk, that is those which require those resources for nuclear power project like uranium, whereas hydel power project would require water. So resources required, raw material required, input required for them can be different. Even the skill required for these two projects can be different. Next is company specific risk. That is the risk which is to the particular company. Example, downgrading of the credit rating. Credit rating company can downgrade, which will make your cost of raising fund expensive, which will make cost of raising fund more expensive, more difficult also. Managerial personnel can change. Key managerial personnel can change, and because of that the company's efficiency, company's resources can get affected. Company's ability to do the business in the same manner can get affected. Third risk to the company is violation of intellectual property right and other laws and regulation. Fourth risk can be dispute with the worker. Fourth risk can be dispute with the worker. So these factors can affect the cash flow of the entity and access to fund for capital investment. Okay, these are serious risks. This can seriously affect the outcome of a project. If the workers go on strike, you can't produce, you can't manufacture, and if you can't manufacture, you can't sell. Therefore, the level of this is called company specific risk. It can vary from company to company. For example, two banks have different exposure to default risk. Even the bank may be same. For example, State Bank of India is a bank, Cooperative Bank is a bank. Both of them lend money to customer, but where is the exposure to default risk is more? The exposure to default risk is more in case of Cooperative Bank, because they do not do the same due diligence, same exercise which SBI will do before they will grant loan. Now let us come to external factors. In external factors we have like industry specific risk, market risk, competition risk, international risk, and risk due to economic conditions. Now what do you mean by industry specific risk? This risk affect the whole industry. This risk can affect whole industry. For example, software companies. Software companies are going to be subject to change in technology. Artificial intelligence may come and it may make many software companies redundant. Is it right? Automobile companies. Automobile companies are also subject to risk. Government will ban diesel cars, diesel vehicles. So all automobile companies will get affected. Government will bring more and more metros in every city. When more and more metros will come and metros will become efficient, then demand for automobile can go down. So that is going to affect the whole of industry. Okay, steel companies, they will require raw material and raw material may not be available. Raw material required for manufacturing steel is not available. Then all the steel companies can be affected. So the risk is because of regulation, restriction on the industry. The risk can be due to change in technology. The example given by the study material is that regulatory restriction imposed on leather and breweries industries. You might have heard some governments have banned plastic. So companies which were manufacturing plastic, because of regulatory restriction, they have got affected. Companies manufacturing diesel vehicles will be affected because of change in regulation. Next is market risk. This is very serious risk which one has to visualize at the time of starting the project. Market risk would be market related conditions can change. For example, entry of substitute product. Entry of any substitute product can affect you seriously. Earlier we used to purchase camera. You will ask your parents, they used to purchase Kodak camera, Nokia or other cameras. Now do you purchase camera? Who purchases camera? Only those who are professional photographer. Now cameras are already inbuilt into phones. Phone with camera has killed the market for normal cameras. That is a substitute product. Okay. Change in demand conditions. Human beings are peculiar creature. Their demand, fashion, taste, habit will keep changing, and because of that the company can be affected. Okay, fashion will change. They will demand new product and the companies will get affected. Availability of resources can be a challenge. Access to resource can be challenge, and these are called market risk. Like example given, a thermal power project gets affected if coal mines are unable to supply coal requirement of thermal power company. A thermal power project means they require coal for power generation, but the coal supplying companies are not able to deliver coal, they can be affected. One more risk, competition risk. Ask Airtel, what happened to Airtel, what happened to Vodafone? They were enjoying lot of profit. Suddenly Jio came and these two companies were very severely affected. Many small companies have gone out of the market because of the competition. Competition can increase suddenly and you will not be able to notice it also in the beginning. That might totally disrupt your business because the customer can shift from your product to the competitor's product. So there are risks like entry of rival. Product dynamism can change. Product dynamism can change. Demand for product will change. Like for example, in mobile phone business, every 6 months some new technology comes and then the customer will want that new technology. If you are not able to upgrade to that technology, customer will shift to the new technology because the product dynamism has changed. Taste and preference of consumers will keep changing. Is it right? From offline learning, that was the earlier test of the customer, student. They used to come to the classes to learn. They used to get up in the morning. Sometimes they used to take shower and come also, sometimes without, but they used to come, they used to have friends, they used to talk, they used to have breakfast, lunch in the class, they used to play fun with the teacher. Now the taste has changed, nobody is willing to get up only, right? You are sitting at your home and you are eating food also on your bed. You have not taken bath, nobody is going to disturb you. Simultaneously you can watch your Instagram reel also. Customer or the students' taste and preferences have changed, and because of that we also have to shift to this online learning. Is it right? And the last point is, second last point, risk due to economic conditions. Macroeconomic conditions can change. Monetary policy of central government. You might have heard interest rates have been increased, and because of which many businesses would suffer because their cost of funding will go up. Government fiscal policy can change. New taxes can be added. New cess can be added. GST rate, income tax rate can be added. Inflation can go up. Oh my God! And that will make your cost high. That will increase the production cost. GDP can change. Change in saving and net disposable income of the people. This can affect the demand for your product and can affect your risk. And the last but not the least is international risk. Now we are living in a global world. What happens in other parts of the country, other parts of the world, we are also affected by that. You can't say something is happening in China, I am not bothered. Something is happening in USA, I am not bothered. Something is happening in Russia, I am not bothered. It cannot happen like this, because the world is an integrated village now. We depend on demand, we depend on supply. Okay, we import oil, we import food grain, we import machine. Similarly, we export goods and services. Therefore, international conditions can change, can affect our business. Like, some government will ban the product. Do you know that? US government has banned Chinese product. So because of that, many companies in China will get affected. They may put a restriction on the market access. You are not allowed to access the market of that country. There may be a ban on your company or your product. Then there can be global recession. Global recession now affects all countries, not just one country. There are bilateral agreements between two countries which can affect demand and supply of the product, which can affect the movement of goods and services, and the political and geographical conditions keep changing. So there can be sometime dispute between Russia and Ukraine. Sometimes there can be dispute between USA and China. Sometimes there is a dispute between Israel and Iran. And sometimes there is a dispute between India and Canada also. Okay, and that affects the business, that affects the product and services that you import or export. Some governments have started putting restriction on outsourcing of jobs to overseas market. You cannot, like USA, you cannot outsource certain jobs to Indian because Americans are losing jobs. After that long theory discussion, let us come to the main part. For exam purpose, how to incorporate risk in capital budgeting. There are three techniques in the syllabus: statistical technique, conventional technique, other techniques. In statistical technique, you are going to learn probability, variance or standard deviation, coefficient of variation. If you have studied portfolio management chapter before this, already we have covered, right? Then we will see conventional technique, under which we have risk adjusted discount rate, certainty equivalent. These are conventional technique where we adjust the risk either in the form of discount rate or in cash flow. And there are certain advanced technique, other technique or advanced technique, where we have to learn about sensitivity analysis, scenario analysis, simulation analysis and decision tree analysis. So these are some advanced concepts, not very difficult. If you focus, you will be able to understand. We are not going to try to scare you. You have to concentrate, you have to practice, and this chapter can turn out to be an easy and scoring chapter for the exam. Our notes are very comprehensive, compiled for the questions asked in last about 20-25 years, and in all the study material RTP, MTP. So be assured that you have covered almost everything which institute can ask in the notes. Now question is, what is risk? I have also added something from my side. First is, what is risk? Risk is the probability, possibility, situation that the actual outcome may deviate from expected outcome. Actual outcome may deviate from expected outcome, that is the risk. If actual outcome and expected outcome are same, there is no risk. Invest in a government bond which says we will give you 7% interest. After 5 years also when you go, they will calculate interest at the rate 7% and they will hand over you the amount. Go to State Bank of India and say I want to deposit in a 5-year FD. They will say we'll give you 6.25% interest. After 5 years when you go, they will calculate interest at 6.25% and hand over you the amount. There my actual outcome and expected outcome are same. But when you invest in, let's say, equity share, you have done all the past data analysis, last 10-year performance you have analyzed, you have studied all the annual reports, you have studied all auditors report, etc. and you calculate that you might earn 10% return, but it is possible you may get more than 10 or you may get less than 10%. So that is the risk. Invest in gold. Today after the class, buy 10 kg gold, okay, example, and you will expect suppose 12% return. You will expect that gold will appreciate by 12%. After 1 year, next year, after 12 months, you see what is the return you have actually earned. You may earn more than 12, you may earn less than 12 also. That is where the risk lies. To those asset class where the actual outcome can deviate from the expected outcome, they are called risky assets. A project is also risky. A capital budgeting project is also risky because we are estimating certain cash flows in future which may or may not be realized. Risk means variability of return from those that are expected. That is, what we expect and what we get can be different. Risk means, in finance, risk means probability of losing money. For exam, risk has a different meaning, okay, but for financial purpose, risk means you will lose money. Risk means volatility of return. But one good thing about risk is that risk can be measured. Risk can be measured by assigning probabilities. So next few minutes we will learn how to calculate risk. Decision making rule number 1 for today. First golden rule for today: if other things remain the same, project which carries lower risk will be selected. Other things remaining same, project which carries lower risk will be preferred. What does that mean? There are two projects. Expected NPV is suppose 1000 each, but standard deviation is 100 and 200. Please reply, everybody, which project you are going to select. Which project you are going to select? Project A will be selected. Very good answer, because risk is low. If expected NPV is same but the risk is low, I will select project A, other things remaining same. Next point is, what is uncertainty? Uncertainty is a more dangerous situation, more riskier situation than a risky situation, because probabilities cannot be assigned. Probabilities cannot be assigned. We don't have enough data to even assign the probability as to what can happen. Is it right? Mr. Hari is right. Okay, now next concept is what is probability. Long back in your 12th standard or foundation, you have studied probability. Probability means possibility of happening or non-happening of an event. Probability of happening or non-happening of an event is called possibility of happening or non-happening of an event is called probability. Probability is very important to understand the risk involved. For example, if I say a project probability of success, that is probability that NP will be positive and probability that NP will be negative, if suppose this is 0.01% probability and this is 99.99% probability, what do you understand from this? Is the project highly risky or less risky? Is the project highly risky or less risky? High risk, because the probability of success is 0.01. You will rethink before you start this project where the probability of success is so low. But suppose I change the probabilities. Suppose I change the probabilities. The probability says success will be 99%, only 1% chance of failure. What will you do? Would you like to undertake such project where the probability of positive NPV is very high? Yes. So probability helps you to understand the risk. Okay. CA exams are also risky. CA exam, BCom exam. First we'll discuss BCom. What is the probability of success? Anybody? BCom exam probability of success? 99%. Very good. 1%. Only if you are really talented you will fail the BCom exam. If you are extraordinary talented, then only you can fail BCom exam. Otherwise you can't. You have to really struggle to fail in the BCom exam. And what about CA exam? What is the probability of success? Say 20%. So that is why we say CA exams are risky. Okay. They make serial also on CA exam nowadays to tell you that boss this is so difficult. It's not. You need a proper guidance, you need a comprehensive understanding of the syllabus and lot of practice. You can do it. Probability lies between 0 and 1. Sum of the probability is 1, or if you are writing in percentage, 100%. If your total of probability is not 1, you are making a mistake in the calculation somewhere. How do I compute probability? Suppose in the past I have used 100 machines and I found NPV were like this. NPV of 10 machines were minus 10 lakh. NPV of 60 machines were plus 20. NPV of remaining 30 machines were plus 50. Now my question is, what is the probability of getting a negative NPV of minus 10? What is the probability that NP will be negative? What is the probability that NP will be negative? Anybody? Probability 10 machines out of 100 has negative in the past. So we'll say 10%. What is the probability of getting NPV of 20? 60 machines out of 100 in the past have produced 20 NPV. So 60%. What is the probability that NPV will be 50 rupees? 30 machines in the past out of 100 have produced 50 plus NPV. Therefore, we will say NPV is 30% in the third scenario. So Hari is right, Rajesh Kothadia is right. Please reply whatever you can. Next is assignment of probability. We'll see how to assign probability. First is what is the next point is expected value. The heading is wrong here. The heading should be expected value. Keep the notes in front of you. Keep the notes in front of you. Everything is written there. You are a final student. We cannot waste your time in dictating all this. Everything is in the note. Only concentrate on learning, understanding. Okay. Expected value means average or mean value. Expected value means average or mean value. You will hear this term expected value a lot in this chapter. So what do you mean by expected value? It simply means average. It simply means mean. How do you compute expected value? When probabilities are given, just multiply respective value with their respective probability. Just multiply the respective values with their respective probabilities. Mathematically, expected value is the sum of probabilities into value. I'll take one example for you. Since last many minutes you have not written anything, there is one example on expected value in your notes. Write down these two columns there. Write down these two columns, NPV and probability, and then you have to compute expected value yourself. So I will tell you how to compute expected value, average value, mean value. Write NPV column, write 3000, 6000, 12,000, 15,000. Probability write 0.1, 0.4, 0.4, 0.1. Now somebody is asking you, what is the expected value? What is on an average you can expect an NPV? What average NPV you can expect? What average NPV you can expect? Please try. Please try. You will say 3000 into 0.1, 300, 6000 into 0.4, write in the book, 2400, write in the book, 4800, we have given the table so that you can write to 4800, 1500. Can you please take total and confirm what is the expected value? The total is 9000. Very good. Very good, Divya. Total 9000 was right. Now what does this 9000 represent? This 9000 represent average NPV, expected NPV, mean NPV. Why it is average, I will tell you now. Well, I'll tell you. Suppose in the past you have used 10 machines. Suppose in the past you have used 10 machines. One machine had an NPV of 3000. 4 machines had an NPV of 6000. 4 machines had an NPV of 12,000 and 1 machine had an NPV of 15,000. Total 10 machines. These are their probabilities. These are their probabilities. Now if you are in school, for example, if you are in 5th standard student, what he will do? He will take 3000 NPV into one machine. Then he will take 6000 NPV into 4 machines, 12,000 into 4 machines, plus 15,000 into 1 machine, and he will divide by total number of machines 10. This is what is taught in schools, how to calculate average. You have added all the possibilities and you have divided by number 10. So my answer will be still 9000. You can check. This is also average. This is also average. Therefore, probably they may not explain this properly in the study material, what you are doing in expected value calculation is you are simply calculating average, where probabilities are used as weights. Probabilities are used as weights. Did you know that? Tell me honestly, did you know that you are just computing average when you are computing expected value? Were you aware or were you mechanically learning it? Okay, now we'll solve one question in the notebook. Time to take out your notebook. Time to take out your notebook, pen, pencil, calculator, scale, eraser, and we are ready to go. Question number 11. This is from your study material. Possible net cash flow of the project A and B at the end of the first year, and their probabilities are given below. Discount rate is 10%. So this is a 1 year problem only. Discount rate is 10%, and these are the 5 possible cash flows with their probabilities for 2 projects. Then they are saying for both the project initial investment is 10,000. This is year 0 outflow. This will be year 1 inflow, but because there are 5 possibilities, you have to find average cash flow, expected value. First question is compute the expected NPV of each project, and second question is which project will be preferred, which project is to be preferred. So what I'll do, my first task will be to find out expected cash flow of year 1 for both the project. Then I will discount it using 10%. I'll get PV of cash inflow. I will deduct the initial investment amount, and that will give me NPV of the 2 projects. The one which has higher NPV will be selected. Okay. So write down the answer in the notebook. You have to practice yourself. By reading the answer you will not learn. Some students have the habit of reading the answer. You cannot learn swimming by reading the swimming book. Okay, you can't learn car driving by watching YouTube video. You have to participate. You have to do it. Okay. But still, if you want to try your own way, I cannot stop you. Every 6 months we have exam. Write in the notebook. Calculation of expected value of project A and project B. Calculation of expected value of project A and project B. Please write on your own, then you will learn. First, write down project A. Under that you will find you have 3 columns. Before that you write possible event, 1 column. Then project A, 3 columns. Cash flow, probability, expected value. Project B, cash flow, probability, expected value. Total 7 columns. Start with possible event column A, B, C, D, E. If this happens, this will be cash flow. If event B occurs, this will be the cash flow. That is the meaning of possible event. Depending upon what will happen next year, your cash flows will accordingly change. Okay. Probabilities are given in the problem. Kindly copy from the question probability. Multiply the 2 columns and take the total. Use memory plus function. Use memory plus function. You will write 800, 2000, 4800, 2800, 1600. Anybody for total. Keep the answer ready, and when I say give me total, immediately reply. What is the total expected cash flow of project A? Please reply. Total expected value. One student has replied, very good, 12,000. Okay, now you try project B. Project B on your own. I will check the answer after 20 seconds. I will check the answer and reply on the chat box. Time over. Anybody answer? Anybody answer? 16,000. Confirm 16,000. Is it 16,000? Okay. Now what we'll do? These are the expected cash flow after year 1. I will discount it. I'll get present value, and then I will deduct the initial investment amount 10,000. I will get NPV, the one which will give me higher NPV. Based on the information, we will select that. Write down below the table, the NPV of project A is equal to factor of year 1 is 0.909, 1 divided by 1.10, 0.909 into 12,000 minus initial investment 10,000. Answer please. Come on, answer please. Is it 908? Just check approximately, is it 908? Okay. Now write down below that NPV of project B. Come on, everybody should reply. NPV of project B is 0.909 into 16,000 minus 10,000. Confirm the answer now. 0.909 into 16,000 minus 10,000. Are you getting 4544? 4544. Is it right? Write one note. On the basis of NPV, project B should be selected. Project B should be selected because NPV is higher, because expected NPV is higher. Because expected NPV is higher. Because expected NPV is higher. That note you have to write. If they are asking you which project you will prefer, write this note. Now we'll go to question number 12, again taken from your study material. Ready? Probability of net cash flow for 3 years of a project are given. So this is 3-year problem. By multiplying these numbers, you will get expected cash flow of year 1, expected cash flow of year 2, expected cash flow of year 3, and then you will use 10% discount rate to find the NPV. Initial investment is 10,000 rupees. Similar problem, but this time there is only one project, and first task you have to perform is to find out what is your expected cash flow of each year. Each year there are 4 possible cash flows with 4 different probabilities. So I need to first find out what is my expected cash flow. Write down question number 12, write in the notebook. Write in the notebook calculation of expected cash flow. Calculation of expected cash flow. I will sincerely advise you to write in notebook so that you will learn. You will learn anything when you participate. Okay? By observing, watching, you will not learn. Under that 9 columns we will draw. First, year 1, 3 columns. Cash flow, probability, expected value. Year 2, 3 columns, cash flow, probability, expected value. Everybody write in the notebook, year 3, cash flow, probability, expected value. It won't take much time, but it will give you practice. This is first year cash flow given in question. Probability is given 0.1, 0.2, 0.3, 0.4. Now just multiply, take the total, multiply, take the total. Yes, what is the total of year 1? Anybody? Total of year 1. Total of year 1. Reply fast. Total of year 1. Very good answer. 6,000 is right. Come to next year 2. Year 2, try yourself. Try yourself. These are the cash flow. These are the probabilities. Now multiply and add. Multiply and add. Multiply and add. Anybody for year 2? Year 2 answer. Please check. Year 2, 4,800. Very good answer. Amazing. Year 3. Come on. Year 3. Year 3. Year 3. Year 3. Multiply, add. Reply fast. Year 3. On your own. On your own. Come on. Come on, student. Total of the year 3. 4,200 is right. Very good. So this is like solving a simple question of NPV now. Year 1 cash flow, year 2 cash flow, year 3 cash flow. Discount them and deduct initial investment. That will give you the NPV. So write down next line. Calculation of PV of cash inflow. Calculation of PV of cash inflow. Calculation of PV of cash inflow. 6,000 you multiply by factor of year 1, 0.909. 4,800 you multiply by factor of year 2, 0.826. And 4,200 multiply by factor of year 3, 0.751. These are the present value factor for year 1, year 2, year 3. Answer is 12,573. This is PV of cash inflow. They have asked you NPV. NPV equal to, write down, NPV equal to PV of cash inflow minus initial investment. PV of cash inflow minus initial investment. Answer please. Very easy. Such easy questions are warm-up questions. Okay. Warm-up question. 2573. 2573. Is it right? 2573. So this is my answer of question number 12. These two questions were based on the concept of expected value. This is just a warm-up. As we'll go ahead, the difficulty level will increase. But once your basics are clear, once your foundation is strong, you can do good questions, advanced question also. Now, we'll come to a concept called joint probability. Joint probability. What is joint probability? Probability of two events happening together. Probability of two events happening together. Probability of two events happening together is called joint probability. Is it right? For example, probability of cash flow in year 1 will be rupees 10,000 is 0.5. and probability of cash flow in year 2 will be rupees say 20,000 is 0.5. What is the probability that cash flow in year 1 will be 10,000 rupees and cash flow, and means both should happen together, and cash flow in year 2 will be 20,000. So how do we compute this? Will you add them, subtract them, divide them, or multiply them? So the answer is joint probability is found out by multiplying the product of the probability of two independent events. This is independent event. First year cash flow 10,000, second year cash flow will be 20,000 is an independent event. If both the events have to happen together, you need to multiply. So the answer will be joint probability in this example will be 0.5 into 0.5 is 0.25. That is how we compute joint probability. So in our chapter this kind of situation will be there, where we have to multiply the probability of two events happening together, like cash flow of year 1 will be 10,000 with this probability, cash flow of year 2 will be this with this probability. What is the probability that you will get cash flow in year 1 and cash flow in year 2? Then you have to apply joint probability. Is it right? Suppose two independent event, Virat Kohli will make century, probability is 0.2. India will win World Cup, probability is 0.5. What is the probability? That Virat Kohli will make century? You can write the answer on the chat box. And India will win the World Cup. These are independent event. Anybody who wants to reply, what is the probability that Virat Kohli will make century and India will win the World Cup? Given their independent probabilities 0.2 and 0.5. Answer 0.2 into 0.5 is how much? Is it 0.10? Yes. So this is my joint probability. How is risk measured? Risk is measured by standard deviation or variance. What we are trying to measure, how much is the data deviates from the expected value. How much is the data deviating from expected value? More the deviation in data from the expected value, higher is the risk. So how to measure that deviation from the expected value? There is a concept in statistics called standard deviation or variance. Risk can be measured by assigning probabilities. Risk can be measured by assigning probabilities. Risk can be measured by a standard deviation or variance. How to compute standard deviation? There are two formulas. This is first formula. When number of observations are given, standard deviation, this is the symbol for standard deviation, sigma. Standard deviation is equal to under root summation x minus x bar square upon n. Summation x minus x bar square upon n. So the idea is that Suppose there is a variable x, 10, 20, 30. We will first calculate total and then average. 60 by 3, average is 20. Then what I do, I take deviation from the mean, because my purpose is to check how much the data deviates from the mean. So x minus x bar, 10 minus 20 minus 10, 0, 10. If I take this total, it will become 0. It will become 0. If I only add the total of the deviation, in this example it will become 0. 0 will indicate that there is no deviation. You will be happy. Oh, I am enjoying a risk-free life. But dear, you can see there is a deviation. Your average is 20, but some numbers are below average, some numbers are more than average. So there is a deviation. You can't say there is no deviation. So what do? I need to remove the effect of positive number cancelling the negative number. How do I remove the effect? By taking the square. When I take the square, all numbers will become now positive only. X minus x bar square, 10 minus 20 square. Anybody? 10 minus 20 square, 100. 20 minus 20 square, 0. 30 minus 20, 10 square, 100. So total is 200. Total is 200. So what I do, I will take total 200, that is my total deviation square. I will divide by 3. Number of times 3. So I will get average, 200 by 3. That gives me answer 66.67. But then this is not comparable with the original data. Original data is not squared. The deviation is squared. So what do? I will take the square root of this deviation, so that the effect of squaring is reversed, so that the effect of squaring gets reversed, and now my answer will be 66.67 square root. Anybody? 66.67 square root is how much? 8.16. Around 8.16 you are getting? Yes, very good. Now what does that 8.16 indicate? 8.16 indicates on an average, the data deviates 8.16 away from the mean on either side. The data deviates 8.16 from the mean. The data deviates 8.16 from the mean. If in another project it is 20.5, which means the data deviates 20.5 away from the mean. More you deviate away from the mean, the risk is more. More you deviate away from the mean, the risk is more. And that is what the standard deviation is trying to measure. If probability distribution is given, when probability distribution is given, so you will be given cash flow 10, 20, 30 with probabilities 0.2, 0.5, 0.3. Then how do I compute the standard deviation? First I will have to find out x bar. So I need to multiply cash flow into probability. Please reply. 10 into 0.2, 2, 20 into 0.5, 10, 30 into 0.3, 9. What is the total? Total is 12 plus 9, 21. 21 is what is called expected value or x bar. Then like the previous one, I will first take deviation from the mean. Cash flow column is x, probability column is p. X minus x bar square into probability. X minus x bar square into probability. So 10 minus 21 I will take 11. 11 square into 0.2 is equal to 24.2. You can use it, transfer to memory plus. 20 minus 21, 1 is square 1, into 0.5, 0.5. Then 30 minus 21, 9. 9 square, 81. 81 into 0.3 equal to 24.3. 24.3. 24.3. These are the deviation square into probability, and take the total. So total comes to 49. After that, you will take the standard deviation, which will be square root of 49. So how much is the square root of that? 7. Just check. I have not checked the calculation doubly. You have to check and confirm if it is right. Is this right? 7. Okay. So if probability distribution is given, this is how we compute the standard deviation. Then one student will ask, why we are not dividing by 3? Why 49 is not divided by 3? We are multiplying by probability, and the sum of the probability is 1. So when you are multiplying by probability, there is no need to divide by 3 or the number of observation. That will be a gross mistake. Okay. The total of the probability itself is equal to 1. So what is the important thing you have learnt? Higher the standard deviation, higher the risk. For example, suppose this is the mean in the center. The data is deviated like this. And another example, this is another data set, another cash flow distribution, but here the data is distributed which is close to the mean. So this diagram indicates higher risk because data is spread. Okay, the deviation from the mean is high, whereas this has low risk. The deviation from the mean is less. The deviation from the mean is less. Okay. Have you understood? Have you understood? Or you want one more example? Suppose there are two batsmen. One is Ishan Kishan, one is Shubman Gill. Have you heard their name? Please tell me, otherwise they are cricketers. Scores by these two batsmen in the last 5 innings. Ishan Kishan 100, 0, 215, 13, 19. Shubman Gill 60, 70, 65, 49, 52. Is it right? Now you see both batsmen, if you look at their average, it will be similar. Average would be similar, but if you look at the standard deviation, here the standard deviation will be very high. The data is deviating too much away from the mean, and here the standard deviation would be low. So how will our team selection committee will decide whom to select? If their average score is same, then they will look at their standard deviation, and the one whose standard deviation is low, variability is low, he will be selected. If the same can be applied for team selection, the same can be applied for project selection also. In projects also, the one which has lower variability will be selected if their expected NPV is same. I hope the concept is clear now. A related concept is variance. Variance, you don't have to remember much. It is like standard deviation, but variance is the square of standard deviation. So if I don't take the square root in that formula, then the deviation is called variance. Variance is the measurement of difference between average of the data set from every number of the data set, and variance is calculated as follows. Same formula: net cash flow minus expected cash flow square into probability. What variance does? Variance measures the range of variability in cash flow data. Range of variability difference in cash flow data, while standard deviation is used to measure risk in the investment proposal. Standard deviation is preferred because standard deviation is measured in the same unit. Standard deviation is measured in the same unit in which the data is measured. And how do you compute standard deviation from the variance? If variance is given, then standard deviation is the square root of variance. Okay, if you need variance, then you take the square of standard deviation. Which is more important method of risk measurement? Variance is a more important method of risk measurement. So today I will need your help in calculations. Okay, because I have not prepared calculation on the screen. You will have to tell me. Keep calculator ready and write down fast. Question number 13. Question for the beginner. Question for the beginners on standard deviation. Those who might have done it earlier will just find it very easy. Calculate variance and standard deviation of project A and B on the basis of following information: possible event ABCD. This is similar problem we had done. Is the data same? Just confirm. Is the data same, so that I can save my time on expected value calculation? Write down same as question number 11. Same as question number 11. But in the question number 11, we have used this for expected value calculation. Now we are using the same information for variance and standard deviation calculation. So I will not calculate expected value. Expected value, refer question number 11. Refer question number 11. For project A, expected cash flow was 12,000. For project B, expected cash flow was 16,000. Just confirm, is it right? So you don't have to do the same thing again. First you write in the notebook, the question is same as question number 11. Then write in the notebook, for expected value, refer question 11. Project A expected value is 12,000. Project B expected cash flow is 16,000. So I am not going to ask you to write it again. It will be an insult to your talent. It will be injustice to your talent to write the same thing again and again. Do you understand? Right. But we need to compute standard deviation and variance. Write down calculation of standard deviation and variance of project A. Calculation of standard deviation and variance of project A. So how do you compute it? First column you write down cash flow. Let us call it X. Then you write down probability. And then you write down, this will write P, and then you write down X minus X bar square into probability. X minus x bar square into probability. Cash flow you can copy from the book. 8,000, 10,000, 12,000, 14,000, 16,000. And probability 0.1, 0.2, 0.4, 0.2, 0.1. X bar for project A is 12,000, which means x minus 12,000 square into probability. This is 8,000. Can you see 8,000 minus 12,000? Then take square into probability 0.1 into probability 0.1. Any answer please? Is it 16 lakh? Is it 16 lakh? Confirm. Okay. Next one, 10,000 minus 12,000 square into probability 0.2. Is it 8 lakh? Please confirm. Is it 8 lakh? Yes. Third one will be 0 without calculation. Fourth one will be 14,000 minus 12,000 square into 0.2. So that will be 8 lakh. Confirm. Next one, 16,000 minus 12,000 square into 0.1. That is 16 lakh. Now take the total of the last column. Take the total of the last column. Is it 48 lakh? 48 lakh. So you will say variance equal to 48 lakh. Variance equal to 48 lakh. And then you will write down standard deviation. Standard deviation will be under root variance. Under root 48 lakh. Please calculate and give me the answer. 2190.90. Just confirm this number. Is it right? 2190.90. Please practice yourself in the notebook. Practice in the notebook. 2190.89 is also right. No problem. You can go ahead with this. 2190.89. Now write down calculation of variance and standard deviation of project B. Of project B, 3 columns again. Cash flows, probability, let us call it X, let us call it P, X minus X bar square into P, and that is X minus 16,000 square into probability, because the expected value was 16,000. Expected value was 16,000. Now write down the cash flow of project B from the question book. 24,000, 20,000, 16,000, 12,000, 8,000. Probabilities write down 0.10, 0.15, 0.50, 0.15, 0.10, and then you take 24,000 minus 16,000 square into 0.1. Anybody getting 64 lakhs, please confirm. 64 lakh is right. Is 64 lakh right? Next one, 20,000 minus 16,000 square into 0.15. Is it 24 lakh? Please confirm. 24 lakh is right. Yes. Next one will be 0. Next one will be 12,000 minus 16,000 square into 0.15. So that is 24 lakh. And the last one 8,000 minus 16,000 square into 0.10, and that is 64 lakh. So can you please give me the total of the last column? Total of the last column will be 1 crore 76 lakh. Right. Write down below. Variance equal to 1 crore 76 lakh, and standard deviation is equal to under root variance, under root 1 crore 76 lakh. Please reply. What is the answer? 4195.23. Please check. 4195.23. 4195.23. Is it right? Yes. So their standard deviation is different. Expected NPV is different. If your only objective is to minimize the risk, then you will select project A because risk is lower. If your only objective is to minimize the total risk, absolute risk, project A will be selected. So this was the answer. Now we'll go to one exam question. These 3 questions that we have taken today were from study material. This question is also in the study material, plus it was originally asked in May 99 exam, originally May 99 exam for 14 marks, and it was repeated also in November 19 RTP and 1 or 2 more exams. Write down important question for exam. Important question for exam. Have you marked important question? Because this is a likely exam question. So we are on question number 14. AS Limited is considering 2 mutually exclusive projects X and Y. Project X will cost 30,000. Project Y will cost 36,000. Initial investment amount is different. Be careful. You have been given the NPVs. So already they have computed the NPV under 4 different scenarios. NPV can be 3,000 with 0.1 probability, can be 0.4, 6,000 with 0.4, then 12,000 with 0.4, 15,000 with 0.1. Same thing is given for Y. First question is bonus mark. Bonus mark means easily solvable. You can solve easily without much effort. Calculate expected NPV of both the projects. Second is compute the risk attached to each project, means standard deviation. You will compute standard deviation. Here you will compute expected value. Just multiply the two. Standard deviation we have just now done. Which project do you consider more risky and why? So we will compare the standard deviation of the two and accordingly answer. One new question which you have studied in intermediate capital budgeting chapter, profitability index. Compute the profitability index of each project. Have you heard profitability index? Yes. Do you remember the formula? Profitability index. Who will give me the formula for profitability index? Those who want to reply can type. Profitability index, PV of cash inflow upon PV of cash outflow. Very good answer. Amazing. You still remember. Please come to answer. Write in the notebook. Write in the notebook. Don't observe. Okay, this is not a movie you have come here for watching. This is for your exam. Question has been actually asked in exam. Question is actually in the study material. What more do you want? Write down. Step 1. Calculation of expected NPV for project X and project Y. Calculation of expected NPV for project X and project Y. everybody should answer. There are total 6 columns I have drawn. First 3 columns are for project X, next 3 columns are for project Y. So columns are NPV in bracket X, probability in bracket P, expected value P into X. Again NPV X, probability P, expected value P into Y. Are you ready for the show? Yes. Write down from the question book. From the question book, copy the NPV of X. Copy the probability of X. Done. Now give me the total of this column. Give me the total. Who will answer first? Let us see. Who will answer first? One student has already replied. Very good. Dedicated student. 9,000 is the answer for project X. Okay, now you try for project Y. Don't sit idle. Those who have done will move to project Y. Those who have done will go to project Y. Come on, project Y. Answer for project Y. Yes, students, please reply. Project Y. Project Y. Check the total. Anybody total project Y? Project Y. 9,000 is right. So if I look at their expected NPV of both the projects are equal. Expected NPV of both projects are equal. Expected NPV of both the projects are equal. So now the management is wondering what should I do? Let us help them. Now we'll compute standard deviation. Write down calculation of standard deviation. Calculation of standard deviation. We'll solve in the same table for both projects. Project X, project Y, under project X 3 columns. NPV in bracket X, probability, then X minus X bar square into probability. Project Y, NPV in bracket Y, probability P, X minus X bar square into probability. X minus X bar square into probability. So I would ask you to do it yourself so that you will learn. This is my NPV and these are the probability. And you have to write here X minus 6,000 square. Was it 6,000 or 9,000? 9,000, sorry. X minus 9,000 square into probability. In the last column, Y minus 9,000 square into probability. So let us solve. Let us try together. 3,000 minus 9,000 square. 3,000 minus 9,000 square into 0.1 into 0.1. Check the answer. If it is significantly different, inform me. Again, 6,000 minus 9,000 square into 0.4, 36 lakh. Very good. Come on, next one. 12,000 minus 9,000 square into 0.4, 36 lakh. And the last one, 15,000 minus 9,000 square into 0.1, 36 lakh. So can you please tell me the answer? 1 crore 44 lakh. Is the answer right? Total 1 crore 44 lakh is right. Yes. In the same way, we'll go for project Y also. Write down these NPVs given in the problem. Write down the probabilities given in the problem, and then you will compute the deviation from the mean. 3000 minus 9000 square into 0.2. Check the answer. Is it 72 lakh? Okay, next 27 lakh. Next one please, come on, reply. 27 lakh. Next one 27 lakh. Next one 72 lakh. Is right. Now you can tell me the total. The total is 1 crore 98 lakh. The total is 1 crore 98 lakh. Just confirm, is the total right? Is the total right? Yes. These are variances. What you have computed now is called variances. But I need to compute standard deviation to measure the risk. Write down below standard deviation for project X. Standard deviation for project X. Take the square root of 1 crore 44 lakh. This 0 should be here. Why it has gone away? Anybody answer of project X? The answer is 3794.73. Very good. Very, very good. You can write in points, you can ignore it also. Okay, now you try for project Y. Standard deviation for project Y. Take the square root of the variance. Come on student, write down little fast. 4450 approximately. Or you want, you can write 4449.71. That is also welcome. You will get around, if you do up to this, you will get around 7 or 8 marks. Now the third question is, which project do you consider more risky and why? Which project do you consider more risky and why? Kindly quickly reply whether you think X is riskier or Y is riskier and why. The answer given by the students is Y. So write down answer C. Write down answer C. Answer C. There are 4 questions A, B, C, D. Answer C. Project Y is riskier. Project Y is riskier as the standard deviation is higher. Sajid Khan is also right. Project Y is riskier as the standard deviation is higher. Very good. Now there is a last question which requires you to calculate the profitability index. Write down answer D. Calculation of profitability index. Calculation of profitability index. Calculation of profitability index. Serial number, particulars, project X, project Y. Since you are highly talented students, I want to give you one chance to prove your intelligence. What is the profitability index of project X and project Y? Your time starts now. 30 seconds. Anybody wants to reply can answer. This question was asked in the exam. One student has replied 1.20. What is 1.20? Profitability index of project X. One student has said 1.20. What about other students? Are you trying? Those who are learning from home, you must also try. Test yourself, push yourself to the limits and see whether you can answer this basic question. Profitability index is nothing new for you. You have passed that exam and reached up to this point. You are watching this video means you have passed profitability index in one of your exams earlier. The formula is PV of cash inflow upon PV of cash outflow. Understood? What is PV of cash inflow? You are given initial investment of the project. How much was that initial investment? 30,000 for project X. You are given NPV. You have computed NPV 9,000. NPV plus initial investment. NPV plus initial investment is equal to PV of cash inflow. Is equal to PV of cash inflow. PV of cash inflow will be, in case of project X, 30,000 plus 9,000. 39,000. 39,000 divided by 30,000 will be the profitability index. In case of project Y, careful, 36,000 plus NPV is 9,000. If NPV is 9,000 and investment is 36,000, which means your PV of cash inflow will be 36,000 plus 9,000, 45,000. 45,000 divided by 36,000. 45,000 divided by 36,000 would be the answer for project Y. So I got some answers. 1.25 I got it, which seems to be right. Write down PV of cash outflow. PV of cash outflow 30,000, 36,000. See, I will repeat, in your basics of capital budgeting, NPV is equal to PV of inflow minus PV of outflow. Can I say PV of inflow is equal to NPV plus PV of outflow? Yes, yes. This is my outflow, this is my expected NPV. If I add these two, I will get PV of inflow. That will be the basis for profitability index calculation. Point number C, write down. Point number C, PV of cash inflow A plus B, 39,000, 45,000. I thought it was easy, but initially you made mistake. Then write down last point D, PI. PI means profitability index. Profitability index C upon A. Point number C upon point number A. 39 upon 30 is 1.30, and for project Y you are right, 1.25. 1.25. So I found some of you making mistake here, but at least now you have understood. In the exam you will not do that mistake. 2 or 3 marks will be allocated for this answer. Is it right? Welcome to coefficient of variation. Wow. Coefficient of variation is a relative measure of risk. Standard deviation is an absolute measure of risk. Coefficient of variation is required when the expected NPV and the standard deviation both are different. Then I need to check which is relatively more riskier. Which of the two project is relatively more riskier, and for that we will go to another concept called coefficient of variation. It measures risk per unit of return. That is, standard deviation divided by your expected return or average value. That tells you for every 1 unit of return how much risk you are taking. So between two projects, the one which will have higher coefficient of variation means that is relatively riskier, and then according to your risk taking ability you can decide. You can use coefficient of variation for also adjusting the discount rate. The project which will have higher coefficient of variation will be discounted at a higher rate. The project which will have lower coefficient of variation may be discounted at a lower rate of discount. Some company may fix a cutoff also, that if coefficient of variation is more than this, then I am not going to accept that project. If coefficient of variation is less than this, then I am going to accept that project. So this way, coefficient of variation can help the entity in decision making, in making selection between two or more projects, in making adjustment to the discount rate. So that was about coefficient of variation. Now we'll read the notes given to you. Same thing I have explained. Standard deviation should be used only when different investments have same expected rate of return. Right here, refer question 14. If you refer question 14, expected NPV was same 9,000. So on the basis of NPV they were similar. When NPV is similar, I can take decision on the basis of standard deviation. The one which has lower standard deviation will be selected. But sometime expected return and standard deviation both can be different. Expected return and standard deviation both can be different. If expected return and standard deviation both are different, then in that case, now here you write refer the previous question that we solved, question number 13. Then I am not able to take decision correctly. For example, in question number 13, we have two projects A and B. Their expected NPV was question number 11. Expected NPV was 908 and 4544 from question number 11, and standard deviation from question number 13. Standard deviation from question number 13 was 2190.90 and 4195.23. This was my question number 11 and 13. Here you will find your expected NPV is different, standard deviation is different. How to make a decision? If you want project B, you have to also face high risk also. You have to also face high risk. So in that scenario, management may decide on the basis of coefficient of variation. So how do I compute coefficient of variation? Coefficient of variation is standard deviation upon average. So let us try for project A. For project A, can you please reply? 2190.90 divided by 908. 2190.90 divided by 908. So the coefficient of variation will be 2.41 here. Whereas in project B, 4195, my mistake, 4195.23 divided by 4544. So that has a low coefficient of variation, around 0.92. So you will say project B is relatively less riskier. Project B is relatively less riskier. So if the decision has to be based on relative riskiness, then project B will be selected. If the objective is to maximize NPV, B will be selected. But if the objective may be to minimize the lowest absolute risk, if the objective can be to minimize the lowest absolute risk, project A can be selected. Okay, so the decision will depend upon what is your base for taking decision. In general, if they ask this question, you will say project B will be selected because coefficient of variation is lower, relative risk is lower. So come back to your notes. How do you measure coefficient of variation? It is a measure of risk per unit of expected return. The formula is standard deviation upon R bar. Standard deviation upon R bar. And how do you interpret it? When you are comparing two options like this previous one, the one which has higher coefficient of variation, project A, is relatively riskier. There the risk per unit of return was more compared to project B. In project A, for every 1 rupee of return the risk was 2 point something, whereas in project B, for every 1 rupee of return the risk was less than 1, 0.9 something. So this is how coefficient of variation is calculated. One example is printed in the book only with solution. Just focus. Suppose there are two projects A and B. Their expected return are different, 12 and 20. Standard deviation is different, 9 and 10. Now comparison of such projects will be difficult because in project B, if return is high but risk is also high, so how do I know which is relatively riskier? To compute the relative riskiness of the two projects, we will compute their coefficient of variation. Coefficient of variation of project A is 0.75, 9 by 12, and for project B 10 by 20, 0.5, and you will say project B is relatively less riskier. Project B is relatively less riskier because for every 1 rupee of return the risk is 0.50, whereas in project A for every 1 rupee of return the risk is 0.75. So this can help you to take decision. If your objective would be to minimize the relative risk, project B will be selected. You can use it for discounting purpose also. If project B has a lower CV, use lower discount rate. If project A has a higher CV, you can use a higher discount rate. Now again we'll solve one question number 15. Are you ready for this amazing question? I think this question is coming for the third time. Is it the same question like 11 and 13? Is it the same question? Yes. So I don't need to compute. Expected value, variance, standard deviation again. Is it right? Do you agree? I will directly compute their coefficient of variation. Write in the notebook. In the notebook you will write for expected value refer question 11, for standard deviation refer question number 13. After writing these 2 points, now write down the heading calculation of coefficient of variation. Calculation of coefficient of variation. Heading, write down calculation of coefficient of variation. Calculation of, heading, write down calculation of coefficient of variation. Then you draw this table, 4 columns. First column project, second column coefficient of variation, third column risk, fourth column expected value. Fourth column expected value. Fourth column expected value. Fourth column expected value, project A, coefficient of variation. You will go to your question number 13. Question number 13. Question number 13. What was your standard deviation? Do you remember? Question number 13. Was it 2190? Yes, 2190. And in question number 11, what was your expected value here? 12,000. 12,000. Some numbers they have changed probably. Is it right? Some numbers they have changed. The question is not same. Wait. Question is not same. These numbers are different. So what you do? You change the question. Make it 8,000. Then make it 10,000. Make it 12,000. Make it 14,000. Make it 16,000. Probabilities are same. For project B also there are different numbers. So my dear student, please change your question so that we don't have to do the same work again just because of some numbers have changed. Make it 24, 20, 16, 12 and 8. Question number 15, I am making some changes so that it matches with question number 11 and 13. Have you rectified? Have you rectified? Have you rectified? Yes. Okay. Rectify that. Rectify in that question. In your original question number 15, you have to make changes. Reduce by 2,000 rupees all the numbers. Reduce by 2,000 rupees all the cash flows. Now come back to this format. Otherwise later on you will get confused. So right now only rectify. So we will save lot of time because of that. 2190.90 divided by 12,000 will be equal to how much now? Are you getting 0.1826? 0.1826 and this one 4195.23. 4195.23 divided by 16,000. Divide by 16,000. So that is 0.2622. 0.2622. 0.2622. 0.2622. So now if you look at the relative risk is less in case of project A because coefficient of variation is low, and relative risk is more in project B. Relative risk is more in project B. Expected value is less, expected value is more. Expected value is less, expected value is more. Now the question was, which project will be selected? Now we have got all the information. We have got their expected value, we have got their standard deviation, we have got their coefficient of variation. So write down, note, on the basis of relative risk, project A would be preferred. On the basis of relative risk, project A would be preferred. On the basis of relative risk, project A would be preferred. Is it right now? Can we go to the next question now? Question number 16. Question number 16 from your study material. One more question from study material. Cyber company is considering two mutually exclusive proposal. Investment outlay of both the projects is rupees 5 lakh and each is expected to have a life of 5 years under three possible situations, and their annual cash flows and probabilities are as under. Cost of capital is 7%. Which project should be accepted? Which project should be accepted? Okay. So we'll have to compute two things, NPV and standard deviation, and if required, if both are different, if NPV is also different, standard deviation is also different, then I will go to coefficient of variation. But if suppose NPV is equal for both, then the one with lower standard deviation will be selected. If standard deviation is equal, the one with higher NP will be selected. But if both are different, then I will go to third statistical technique, coefficient of variation. Is it right? So write down calculation of standard deviation of two projects. Calculation of standard deviation of the two projects. First we'll write project A. First we'll write project A. Project A. Under project A, 3 columns. Under project A, 3 columns. Which 3 columns? Same 3 columns we have drawn earlier also. Project A will have cash flow, probability, expected value, and x minus x bar square into probability. Then project Y, project B you can write, project B, cash flow, probability, expected value, x minus x bar square into probability. This will help me with standard deviation. This column I'll call it x, this I'll call p. This will be x into p. This column I'll call x, this I'll call p, this x into p. Ready? So start. Project A cash flow 6 lakh, 4 lakh, 2 lakh, and probability is 0.3, 0.4, 0.3. Project B cash flows are 5 lakh, 4 lakh, 3 lakh. Probabilities are same, 0.3, 0.4, 0.3. So now you will have to cooperate with me and give me the answer. So 0.6 lakh into 0.3 is how much? 1,80,000. 4 lakh into 0.4, 1,60,000. 2 lakh into 0.3 would be 60,000. 220 and 83, 4 lakh. Is the total 4 lakh? Please confirm. Is the total 4 lakh? Say yes. 4 lakh is right. Now this column will be 6 lakh minus 4 lakh square into 0.3. 6 lakh minus 4 lakh square into 0.3. How much is that? Anybody? 6 lakh minus 4 lakh square into 0.3. Please reply. Oh my God, this is such a huge number. It is not fitting in the calculator only. 6 lakh minus 4 lakh, 2 lakh square into 0.3. 2 lakh square into 0.3. How much is that? Okay, that what you do, that you shift it to memory plus. 4 lakh minus 4 lakh will be 0. 2 lakh minus 4 lakh square into 0.3 will again be same number. If you recall it, you will get something like this: 2 4 0 0 0 0 0 0 triple 0. Okay, and then you press the square root button, you will get the standard deviation 154,919.33. This is how standard deviation will be calculated. Torturesome question. Okay, no problem, we have got the answer. In the exam also, if they ask you, don't get worried, you can do it. 5 lakh into 0.3, 1,50,000. 4 lakh into 0.4, 1,60,000. This is 90,000. So please tell me the total now. How much is the total? Again 4 lakh you are getting. 4 lakh. Is 4 lakh right? Is 4 lakh right? Now we'll take 5 lakh minus 4 lakh, 1 lakh square into 0.3 equal to memory plus. Then 4 lakh minus 4 lakh is 0. Last one, 3 lakh minus 4 lakh square into 0.3 equal to memory plus memory recall. So you will get something like this number: 6 0 0 0 0 0 0 triple 0. Okay. Oh my God. And then you press the square root function. Press the square root function, you will get 77459.66. 77459.66. Is it right? This is my standard deviation. This is my standard deviation. These are their expected cash flows. 4 lakh is the expected cash flow. Up to this you have done. Please confirm, up to this you have done. Up to this you have done. I have to go to the next page. Right. Now write down calculation of NPV. Calculation of NPV. Year, cash flows, and PV annuity, PV factor, present value factor, PV factor and present value. NPV for both projects will be same because their initial investment is same, expected cash flow is same. Initial investment is same, cash flow is same. Year 0, how much is the initial investment for each project? 5 lakh. First paragraph, present value factor 1, 5 lakh, outflow. Year 1-5, year 1-5 expected cash flow is 4 lakh rupees per annum. Expected cash flow is 4 lakh rupees per annum. Please tell me the annuity factor. Discounting factor is 7%. Present value factor at 7%. Anybody who wants to reply annuity factor? Annuity factor. Not for 1 year. You have to answer for 5 years. You have to answer for all 5 years. Annuity factor. 1 divided by 1.07 equal to memory plus 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 5 times, then memory recall. So 4.1 you are getting. Multiply 4.1 into 4 lakh and that is equal to 16,40,000. So NPV will be equal to 11,40,000. 11,40,000. If NPV is equal, we will have to make a decision on the basis of standard deviation. NPV is equal, so note, NPV of both projects. NPV of both projects are equal. Hence, the decision will be based on standard deviation. Decision will be based on standard deviation. Project B will be selected because standard deviation is lower. Because standard deviation is lower. Project B will be selected because standard deviation is lower. Project B will be selected because standard deviation is lower. Project B will be selected because standard deviation is lower. Is it right now? We'll go to next question number 17. We'll go to next question number 17. Please come to question number 17 now. KLM Limited is considering taking up one of the two projects, Projects K and Project X. Both the projects have same life, require equal investment of 80 lakh each. Both are estimated to have same yield. As the company is new to this type of business, the cash flow arising from the project cannot be estimated with certainty. An attempt was therefore made to use probability to analyze the pattern of the cash flow from other projects during the first year of operation. The pattern is likely to continue during the life of these projects. The result of the analysis are as follows. Project K, Project R, cash flow are given, probability is given. You are required to calculate variance, standard deviation and coefficient of variation. Which of the two projects is riskier? Which of the two project is riskier? So you will have to check whose coefficient of variation is more, and the one which has a higher coefficient of variation will have a higher risk. Is it right? So write down calculation of standard deviation and variance. Calculation of standard deviation and variance. Under that you write down project K 4 columns, project S 4 columns. Columns will be cash flow, probability, expected value, x minus x bar square into probability. Cash flow, probability, expected value, x minus x bar square into probability. Only this much they have asked. Okay, not anything else. And then you have to compute their coefficient of variation also. Then you have to compute their coefficient of variation also. Is it right? You have drawn the format. Have you drawn the format? Have you drawn the format? Please reply. Have you drawn the format? Yes. Now write down homework. That was the trick. Question number 17. Do homework. Keep half page blank. Keep half page more blank after the format and do it as homework. Already we have done many questions today on standard deviation. Question number 18. From your study material, a company is considering project X and Y with the following information. Project X, project Y, standard expected NPV. This time they have directly calculated it for you. In the homework question, you have to do this expected NPV and standard deviation calculation. Which project will you recommend based on the above data? Which project would you recommend on the basis of above data? Now the problem is project Y has got a higher expected value, but at the same time it has a higher standard deviation also, and project X has lower standard deviation but lower expected NPV also. Explain whether your opinion will change if you use coefficient of variation as a measure of risk. So what do they want from us? If I have to answer only on the basis of this data without calculating coefficient of variation, then my answer will depend on whether my objective is to maximize the NPV or whether my objective is to minimize the risk. Whether my objective is to maximize the NPV or minimize the risk. Okay. And second question I will answer on the basis of coefficient of variation. Which measure is more appropriate? Which measure is more appropriate in this situation and why? Which measure is more appropriate in this situation and why? So first answer, write down answer part 1. Answer of part 1. On the basis of standard deviation, project X will be chosen. On the basis of standard deviation, project X will be chosen because it is less risky, than project Y. It is less risky than project Y because it is less risky than project Y. Project Y have higher standard deviation, having higher standard deviation. One more line I want to add. If the objective is to maximize NPV, then project Y will be selected. Because it will depend on management's attitude, management's objective. What do they want? Do they want to maximize NPV or do they want to minimize the risk? If the objective is to minimize the risk, X will be selected. If the objective is to maximize NPV, Y will be selected. That is my view. Institute view is only on the basis of risk, but the decisions are not only on risk. Now write down answer 2, answer of second part. So for that, first I need to compute the coefficient of variation. First I need to compute the coefficient of variation. First we need to compute coefficient of variation. Write down coefficient of variation of, first you write this one. First you write X, coefficient of variation of X, write down. Coefficient of variation of X, write down. Standard deviation upon expected NPV. Standard deviation upon expected NPV. Standard deviation upon expected NPV 90,000 divided by 1,22,000. 90,000 divided by 1,22,000. Please check the answer. I have not checked. I have relied on the institute. Is it 0.738? Is it 0.738? Very good. Now below that write down coefficient of variation of Y. This you write below. Coefficient of variation of Y. Come on student. 1,20,000 divided by 2,25,000. The answer is 0.533. Very good. Compare the two. If you have to decide on the basis of coefficient of variation, which one would you select? Please reply. Coefficient of variation. Which one would you select? Which one? Project Y will be selected. Very good. Write a note. On the basis of coefficient of variation, please reply everybody. On the basis of coefficient of variation, project X appears to be riskier. X appears to be riskier and hence Y should be selected. Project X appears to be riskier and hence Y should be selected. This was answer of second part. Third part, which measure is more appropriate in this situation and why? Which measure is more appropriate in this situation? So you will write a note. Answer 3. NPV method in such conflicting situation is best. NPV method in such conflicting situation is best because the NPV method is in compatibility NP method is in compatibility of the objective of the wealth wealth maximization in terms of time value is in compatibility of the objective of wealth maximization in terms of time value. But I want to add one note from my side. Tutorial note is the ultimate decision will depend upon the management's attitude towards the risk. The ultimate decision will depend upon the management's attitude towards the risk. Okay, because there are two types of people: those who are willing to take high risk for a high return, and those who don't want to take high risk. So accordingly their answer will be different. So this is the answer of this this simple question. This was from your study material. Now the next is, oh, such a warm welcome. Conventional technique we have studied. We have to study two conventional technique for risk analysis. One is called RADR and the second is called certainty equivalent, risk adjusted discount rate and certainty equivalent. We have seen statistical technique, under which we have learned probability, expected value, standard deviation, variance and coefficient of variation. Now conventional technique of risk analysis will include RADR. RADR means risk adjusted discount rate, and certainty equivalent. Next discussion is RADR. I am going to ask you some question, rapid fire round, okay, and you have to answer quickly. Suppose you have to start a new project versus expansion of an existing project. Which one will be discounted at a higher rate? Which one will be discounted at a higher rate? Which one will be discounted? Everybody should reply at a higher rate. The answer is new project, because new project has more risk compared to your existing business. You know your existing business. If you know your existing business, only adding some more machine will not be as risky. Suppose you are a truck operator. You have already got 500 trucks and you are running that business. If you add 10 more trucks, that is less risky. But suppose you are a truck operator and now you enter into a movie production, suddenly a new line of business. Mr. Rajesh is also right. Anup is also right. New project will be discounted at a higher rate. Okay, second example. Suppose you have to start one cement project, cement business, and second you want to start space tourism like Elon Musk has done. They will take money from selected people, take them to the space, give them some feeling of the space and bring back. Another is cement project. Which project do you think is more risky? Which project do you think is riskier? Cement or space? Space tourism. Space tourism. So should they be discounted at the same rate, or whether the space tourism project should be discounted at a higher rate? Answer is obvious. Higher the risk premium, and higher the risk premium, higher would be my discount rate. So what this concept of risk adjusted discount rate says, it says simply the project which will have higher risk will be discounted at a higher rate of discount. So you'll have to add risk premium, more risk premium will be added to projects which are more risky. So risk is incorporated in decision making by adjusting the discount rate. Risk is incorporated in decision making by adjusting the discount rate. The project which will have higher risk will be discounted at a higher rate, and the project which will have lower risk will be discounted at a lower rate. Cost reduction proposal. One more example. Cost reduction proposal versus revenue expansion proposal. Which one will be discounted at a higher rate? Cost reduction proposal or revenue expansion proposal? Come on. Which will be discounted at a higher rate? Cost reduction is internal. To large extent you can control. Revenue expansion is external. We don't know how much sales will happen, that is external. So this is riskier. Use a higher discount rate for a revenue expansion proposal. Similarly, this example we have asked, an expansion proposal will be discounted at a lower rate, but an introduction of a new product will be discounted at a higher rate. Now next is, this is some basic introduction. I have to add risk premium. More the risk premium. A risk adjusted discount rate is sum of the risk free rate and risk premium. Sum of the risk free rate and risk premium. In some question we are going to solve, they have given you risk premium separately, risk free rate separately. Now how this risk premium is calculated? Risk premium is subjective. It may depend on the perception of the risk by the investor of a particular investor and the degree of risk aversion of the investor. So those investors who are afraid of the risk, who do not want to take high risk, for them the risk premium has to be high so that they are motivated to invest in a risky project. So many times risk premium is a subjective term. Mathematically, risk free rate plus risk premium is equal to risk adjusted discount rate. Like if you have studied in capital asset pricing model, do you remember risk free rate plus beta into RM minus RF? This beta into RM minus RF is risk premium. That depends on beta, the variability of the project with respect to market. So this is risk free return plus risk premium. Lower the risk, higher the risk premium. Lower the risk premium. Become lower risk. So you get lower salary. CA, higher risk. So you get higher salary. Next point is advantage of risk adjusted discount rate. This is easy to understand. Most of you will be able to easily understand that the project which have higher risk will be discounted using high rate, and it is easy to incorporate also in the capital budgeting decision. You can simply adjust the discount rate. You can simply adjust the discount rate by adding risk premium to the risk-free rate. But what is the limitation of risk adjusted discount rate? Disadvantage or limitation is point number 1. It is written point number 2 in your book actually. Though NPV can be calculated, but it is not possible to calculate standard deviation of a given project. So under RADR method, we do not calculate standard deviation. Under RADR method, we can compute NPV, but we don't compute standard deviation because you don't need to apply the probabilities here. And second question is subjectivity is involved. How much should be risk premium? How much should be the risk premium is difficult to decide because it can vary from person to person. So there is some subjectivity involved in the calculation of RADR. Now we'll solve one of the highly tested questions on RADR, question number 19. Is it right? So today we'll not take a break. We will leave you 15 minutes early, okay, without break. Or what do you want, break plus 15 minutes more or without break? No break, okay, no break. So we'll just leave you a little early today. You are right. Question number 19, although I am feeling little hungry, but it's okay. Study material question, May 19 RTP question, similar question in November 19 RTP, August 18 MTP 5 marks and April 22 MTP 5 marks. Now I need to tell you one thing, all these sources which I have written are from old final syllabus because this chapter was there in the old final syllabus. This chapter was there in the old intermediate syllabus also. This chapter was there in the old intermediate syllabus. Because some students raise this query, how can you have this question in April 22 MTP or August 18 MTP? So this chapter was there in the old syllabus and old intermediate. So the sources are from those reference books, okay. But it was there, so trust me. Question number 19, an enterprise is investing rupees 100 lakh in a project. The risk-free return is 7%. The risk-free return is 7%. The risk premium expected by the management is 7%. 7 plus 7, 14. Risk premium is already given to you, just add it, do not apply too much intelligence, okay. So this is that beta into RM minus RF already given to you. The life of the project is 5 years. Following are the cash flows that are estimated over the life of the project. 1, 2, 3, 4, 5 cash flow, compute NPV of the project based on risk-free rate and also on the basis of risk-adjusted discount rate. So what I have to do? I have to compute PV using 7% and I have to use PV using 7 plus 7, 14%. Such a simple problem. Write down, write down in the notebook calculation of NPV using risk-free discount rate. Calculation of NPV using risk-free discount rate, 4 columns, year cash flow discounting factor at 7% and present value. Then you write down year 1, 2, 3, 4, 5 cash flows, write down as per the question They have not mentioned whether cash flows are risk-free cash flow or risk-adjusted cash flow. Question has a mistake. They have not specified the type of cash flow. Cash flow can also be risk-free or risk-adjusted. Discounting factor, write down please. Use 7% factor. Use 7% factor. Then multiply. Use memory plus function. Cash flow into factor equal to memory plus. Cash flow into factor equal to memory plus. Cash flow into factor equal to memory plus. Do it 5 times. After you have done it, press memory recall function. That will give you PV of cash inflow 244.34. Can you please confirm, is it right? Is it right? Is it right? Okay. Less initial investment. Less initial investment 100. Less initial investment is 100. Therefore, NPV 144.34. 144.34. Now write down case 2. Calculation of NPV using risk adjusted discount rate. Calculation of NPV using risk adjusted discount rate. You can use short form RADR. Below that you first write risk adjusted discount rate is equal to risk adjusted discount rate is equal to risk free rate plus risk premium. You will write in the notebook risk free rate plus risk premium. Below that write 7 plus 7 equal to 14%. 7 plus 7 equal to 14%. Then please draw this table. Year, cash flow, rupees in lakhs, discounting factor at 14%, present value of cash flow rupees in lakhs. There are 5 years. These are the cash flows given. Copy from the question. Copy from the question. Now take calculator. 1 divided by 1.14 equal to write in 3 digits. Multiply now and press equal to and memory plus so that you don't have to add it separately. Ready? Check. 21.93, 46.14, 50.63, 47.36, 33.74, 33.74. Is the answer right? Is the answer right? Just check. Yes. Therefore, the total PV is, memory recall now, memory recall function 199.79, 199.79 minus initial investment. All questions of your study material will be covered. Less initial investment 100. Therefore NPV is 99.79. NPV is 99.79. If you use RADR, NPV is much lower than risk-free rate. Okay, that was a very basic question, warm-up question. Now we'll come to exam question. This question was originally asked May 99 exam, and now they have asked in November 5 and some more exams. This question is also there in the study material. Is it right? I have not repeated all those questions because they are all same. So question is, determine risk adjusted NPV of the project. Determine risk adjusted NPV of the projects. Now here we are given 3 projects. Their initial investment is given, life is given, annual cash flow is given, coefficient of variation is given. The coefficient of variation means risk upon return. Okay, this is lowest, this is highest, this is moderate. The company selects the RADR on the basis of coefficient of variation. So this is the utility of coefficient of variation. What color is that? Coefficient of variation is used for discount rate. So their policy is, if coefficient of variation is 0.4 on the screen, they will use 12% discount rate. If coefficient of variation is 0.8, they will use 14% discount rate. And if it is 1.2, they will use 16% discount rate. To make your life simpler, your kind institute, big-hearted institute has given you the annuity factor also for 12, 14 and 16%. You should give a big thank you to your institute for asking such easy question for 6 marks. So what is the question? The question is, you have to find out the NPV and you have to select the project. Which project you will select? Okay. Determine the NPV and you have to also answer which is better. The one which will have higher NPV will be selected. So one by one I will solve. First write down calculation of NPV of project A. Calculation of NPV of project A. Calculation of NPV of project A. Total 5 columns. Total 5 columns you will draw. Year, particular, cash flow. For project A, discounting factor is 12%. For project A, discounting factor is 12% because the coefficient of variation is 0.4 and for 0.4 they have decided 12%. Start. Year 0. Cash flow is 1 lakh. Discounting factor is 1. Discounted cash flow 1 lakh. For 1-5, cash flow is 30,000. Discounting factor is given 3.605. Given in the problem, don't try yourself. Multiply 1,08,150 and then you take the total of the last column. It comes to 8150. Now write down next line, NPV of project B. NPV of project B. NPV of project B, same format. Same format. Year 0. Cash outflow will be 1,20,000 given in the problem, and 1-5 cash inflow again given 42,000. Factor is also given 3.433. Multiply 144,186. Calculate NPV. Calculate NPV 24,186. Very easy question. Okay, very easy question. One more. Now write below NPV of project C. NPV of project C. Format. After drawing the format, write year 0. Cash outflow 2,10,000. 1. 2,10,000. 1-5 cash inflow 70,000. Factor is given. Factor is given below 3.274. Factor is given below 2.73. 3.274. Multiply 229,180. This is one of the easiest question ever asked in final. Everybody should get full marks. 19,180. which project has got highest NPV? Can you check and tell me which project has highest NPV? Which project? B. Is project B having highest NPV? So write down advice. Project B should be selected. Project B should be selected because NPV is highest. NPV is highest. Project B should be selected because NPV is highest. Is it right? So today we are going to stop here. We are going to continue on 3 days holiday are there, Sunday, Monday, Tuesday, because I am going out of station. So these 3 days classes will not be there. Next lecture will be on Wednesday. Next lecture will be on Wednesday. Please note it down. Next lecture will be on Wednesday. Is it right? Any query now? We have tried to cover everything in your syllabus and will continue with the same detailed discussion. Please join our live streaming batch, which is right now going on YouTube. We are also running a scheme where you can pay 3,500 rupees. You will get the 5-year validity video lecture and all the study material, plus you will get access to MCQ app also, which we are launching very soon, and you can watch, you can practice MCQ as many times as possible. Please share this information with all your friends also, because I am sure they will be benefited. You have seen the quality of the lecture, and in case if you think it is up to your standard, up to the institute standard, and you are getting everything, you must also spread this word with your friends and relative who are in CA final. Okay, so thank you very much. See you on Wednesday now. Bye bye.